Before we get to Matt, I'm thrilled to announce a new options trading product over at Schaeffer's, Vertical Options Trader. Curated by founder and CEO Bernie Schaeffer himself, vertical options are front month, out of the money vertical spreads, or otherwise known as debit spreads. They're the perfect strategy for trading options on the fastest moving, most volatile stocks in the marketplace, and that sounds pretty relevant right now. Matt actually explains this in far greater detail than I ever could at the end of this episode, but what I can tell you is that there's a sale going on now for our 41st anniversary coming up at the end of the month. We're doing $495 for 41 months of service, and that offer is valid through the end of July. Hit the link in this episode's bio to sign up, or visit schaeffersresearch.com for more details. Now, here's Matthew Timpane. Ladies and gentlemen, welcome back to Schaeffer's Market Mashup. It is Wednesday, July 13th. I'm thrilled to bring you an in-house guest today. Please welcome Schaeffer's Senior Market Strategist and Chartered Market Technician, Matthew Timpane. Long-awaited debut on the pod. Great to have you on.
Yeah, thanks for having me on, Patrick. Definitely, I've listened to our podcast for quite a while, and I've been eager to get on.
On the radio is long-time listener, first-time caller.
Yeah, there you go. That's exactly it. The classic mantra there.
We got a wide range of stuff to talk about today. You recently at Schaeffer's had a very successful put option trade. The Abbott Laboratories, ticker ABT, July 115th strike. I always like doing this. I've done this with Chris. I've done this with Todd. It's like pulling up a highlight video and just saying like, hey, like walk me through what you're thinking here on this play and how did you react? So let's do that to start.
Yeah, definitely. So the Abbott Laboratories July 115 strike put position that we put on, I believe it was June 8th. When we entered the position, it had recently failed at the 80-day moving average at that time, which really had been a significant moving average since 2020, where it kind of found multiple bottoms and now had been finding resistance at this level during the downtrend. So it was in a bear flag pattern as well, and then rolling through that near-term uptrend and then breaking down through the 20-day moving average. So very highly technical type of trade. It was also really kind of holding below and rejected right at that 100-week moving average as well, which was an area in 2016 that it kind of struggled at to move above once it entered below that area. So, and that was kind of really the last significant bear market for Abbott Laboratories was 2016. So when it broke below the 115 level is where we entered that position. It was also another previous support area in 2021 and resistance in 2020. So this area kind of was really pinpointed on a lot of resistance. There was definitely some sentiment factors that went into this as well. Our in-house kind of proprietary volatility scorecard that we use was an 84. So it was telling us, hey, this stock, even though Abbott Laboratories is typically very much more of a slow mover, it had been kind of the volatility had been outperforming its usual volatility and its peers within the option universe. Additionally, when we were looking at the open interest ratio, it was in the third percentile. So what that was telling me is we had a lot of call buyers kind of in there over the longer term a little bit there, and it was vulnerable to a pullback, and force those kind of call buyers out of the position. So, in shorter term trades, we don't always really look at analyst, ratings as closely as we would if we were putting on a trade that's going to be 3 to 6 months. But there was really kind of some pertinent information that had been coming out about Abbott Laboratories. And that was a big catalyst. I kind of just looked at it as it could provide a little bit more headwinds. And it was still very much bullish leaning, but it was below 22% below its consensus price target. So definitely could see some price target revisions with the recent news that had been coming out about Abbott Laboratories regarding the baby formula kind of fallout there, the contamination, and then the effect that it had on society as a whole, that eventually we had a baby shortage shortage due to it. And that was kind of, I guess, one of the big reasons why it attracted me to that security on top of those technical indicators that we could just see some downside risk. Maybe portfolio managers wanted to get out of this position. So that's what led me to put the position on.
When I looked back through, I mean, that trade, like you just mentioned, had a little bit of everything that a contrarian investor is looking for, as far as multiple moving averages, long term, short term, the analyst optimism in this case, some more specific intricacies regarding the sector and some of the macro events going on. And I'm glad you hit on every single one because they all really work together to make this a successful trade.
Yeah, it certainly did. I believe, it worked immediately, and those are often your best trades. When you see that work immediately, those are the ones that you want to stay in as long as possible. We entered that position on 6/8, and then we took half off near the 13th. So just 5 days later, these positions that work right away are often your best types of trades. We took them off near the May 12th lows just because we wanted to de-risk that position a little bit there. On 6/29, there was two volume spikes that kind of happened prior to that, which kind of got me out of the rest of the trade. It was kind of trying to break back above that 20-day moving average. So it really just wasn't worth the risk of holding on to that position anymore in case it rallied against me. So we do try to hold on to these positions as long as possible if we see that there's convexity there and the ability to kind of hopefully get more out of the position. But what we wanted to do at that point was take the position off, de-risk, because there was upside risk, even though it hasn't broken out to the upside. It was just better to move on to a new stock, new security, and that's kind of where we left off with that.
Yeah, I feel like from the 13th to the 29th is a pretty decent time frame of waiting and holding and then making the right decision.
That's exactly kind of my point. And the fact that, as you're getting closer to options expiration, all you're seeing is more theta decay in that option. And you're just presented with more risk as you approach options expiration. We always love to be able to hold into OPEX, but when you can't, it's just better to get out and move on to the new trade. Give yourself some time in a trade on a new one.
That was a great analysis there, of what you saw. So go a little larger frame here. CPI report, brutal this morning, pretty bleak out there. What are some option strategies out there that can help an investor stay afloat at a time like this?
Yeah, so CPI was horrendous. Obviously, inflation's being driven by energy and food and shelter, just rapidly expanding on the inflation front. It's something that I've obviously watched closely as kind of coming from more of a multi-asset background. And I've incorporated macro factors into my analysis for a very long time. Some things that I think that options traders can do during periods like this, because what you're really trying to prevent to do is getting your face ripped off in a bear market rally, but you also don't really want to be long on a potential next leg lower, right? So you got to be extremely strict in your trading strategies right here. So some things that you can do is keep yourself a diversified portfolio of calls and puts, and then spread those bets across sectors. This way you're not overexposed to direction or any one sector from a macro perspective. Also, like I was saying just a little bit ago, you need to keep your entries and your stops tight. And you want to honor those stops. It's something I've always kind of preached. During bull markets, sloppy entries and stops may be something you can kind of get away with. But in bear markets, this can absolutely ruin you. And then I do have a few other things. Since we are, primarily a long premium buyer firm here at Schaeffer's Investment Research, we do some premium selling. But one of the things that you can do to kind of ease off the high implied volatility environment that we're in is buy maybe more in the money contracts to kind of reduce that IV crush and that time decay that they'll experience when we do get a rally and as we get closer to options expiration for that contract. And then another thing that we often do is kind of either shorten or lengthen our time frames depending on the type of directional strategy that we're using. And by doing this, when we're in these types of bear market environments, we're in negative gamma. If you shorten your time horizon, you often get these, bigger moves because of the market environment. So you can hit your targets faster, get in and out of these contracts. And then that way, if you do have an adverse move against you, you're either out, or, if you want to lengthen it, that way you can kind of handle some of that adverse reaction a little bit. One thing from a personal level that I've done is, options traders can also kind of flip the script a little bit. If you are dominantly a long premium buyer, you can kind of go into selling some more premium here. Like I said, we're living in a high implied volatility environment, even with the VIX, being kind of suppressed. If you look at IV rank of many of the securities, we're in the 80th percentile, 70th percentile. And then when we do have these rallies, if you're trying to play that, like I said, you get this IV crush, it really kind of hurts those returns on the long premium side. But what that is that's a nice tailwind for you if you sell some premium against it. So from a personal perspective, I've been selling a lot more premium in this type of environment, really kind of picking out my support zones and resistance areas to put these trades on. And then I've been doing it through credit spread utilization instead of just selling outright naked calls and puts, because that way I can at least reduce my downside risk if I'm wrong. And that's kind of just some ideas that you could do as an option trader right here in this type of market environment.
Yeah, couldn't have said it any better myself. Listeners, or when this becomes a transcript, might recognize Matt from, he's one of our key representatives on our, the Bazinga boot camps. He also pretty frequently writes our Monday morning outlook, which is delivered to subscribers every, you guessed it, Monday morning. And as the one who edits and kind of cooperates with that, I've always wondered, when you write MMO, what is your thought process? What is your research process? Because I feel like that's a jumping off point for someone who wants to understand the macro areas of the stock market, like you said, that you've been involved with. Because I think most people, they can't open up a website or turn on Squawk Box and really pick off what they need to know for the next week.
Yeah, no, I fully understand that. I've kind of been in that position before, obviously before being a trader and trying to learn everything as a college student, where I first found my love for the markets. But first, as traders, the first thing that we're doing is we're always constantly on the lookout for information and filing away that information daily that could really kind of affect the market and our positions. So that's one thing I think like even a retail person could do is in general, kind of look, to pull out the fluff from all the information that's being thrown to you on the news articles and pull out the data. It's obviously a lot better being a professional trader. We're able to have certain platforms that we can pull up this data anytime that it comes out. But there is plenty of great free sites out there that has the same stuff I know out there. I use a trading platform that is paid, but also they have a free version of it. You can pull up all this economic data. So you can do this yourself and some of the analysis exactly yourself. So the data is the most important thing, though. When you're looking at the news, disregard a lot of the opinions and look at what the data is and what price history kind of tells you from that aspect. When you do look at like weird things like, say like Barron's or Economist covers, half the time, those big themes that are coming out in the financial media are at the exact wrong time. And you should literally be kind of doing the opposite. I know we used to have an archive of all of those articles and how they're wrong, and many other technical analysts out there cover this as well. And so to begin with, what I do, I guess, to bring it back to like starting point of what I do when I'm writing the MMO, I'll look at any of the information I have saved. I'll pull up all of my macro charts. I'll go through them. I will reanalyze everything. So I'll look at, whether it's the broad-based indexes, what economic data that came out the past week, what economic data is coming out the next week, how could that affect the market? And then look at everything, since we're very options focused, from OI or open interest configurations for the major indexes to the sentiment data. Then I'll just develop a framework or an outline to see really what I can or what I can see happening in the next week or two, since as you've noticed, Monday Morning Outlook kind of focuses on a shorter time frame. So I can develop that thesis so it can hopefully better help our readers. And sometimes, I will highlight larger themes that need to be mentioned just because they fit within the broader context of the short-term theme as well. But, after I'm kind of done doing that initial outline, I always kind of look at it quickly and I ask myself kind of two questions. Does this make sense? And what has history shown us? Because sometimes what sounds right really doesn't appear right on paper. And this is one reason why I actually think writing is so important for any trader and investor. Sometimes, when it sounds right, you put it on that piece of paper, you're going to sit there and go, that doesn't make sense anymore. So even if it's just journaling trades or notes on the market on a daily basis, this kind of really makes you think, does this fit the overall theme? Do I have maybe a bias one way or another, and I'm totally wrong to think about it like this when looking at the data itself? Then obviously, there's multitude of factors and there's going to be conflicting factors all the time. You really kind of need to weigh the evidence of those factors for that specific point in time and how it can affect the market. So whether it's looking at economic indicators or technical levels on your index charts or how open interest is working, are we trading near a peak put level where if we go through that, we could be in a delta hedge scenario, or if we're kind of in a bull market, these levels often act as huge support levels where we can really kind of buy that dip. That's just kind of how I guess I go through it, and then just develop, like I said, a nice theme to be able to hopefully benefit the readers of the program so that they can be successful in their trading as well.
Yeah, data, folks. That's really what it's all about. But what I loved what you said there, and especially as a writer, love to hear that of the journaling and the kind of recording, taking the notes and seeing how this sounds on paper, because it does have a different angle and lens to it that could lend you to a different direction of where you wanted to go. I thought that's fascinating. So you're journaling every trade, or how does that work?
Yeah, so I journal every trade. First off, we do drivers, so we pass those around to all of our traders on staff. That way, if anybody sees something that maybe doesn't make sense, they can point it out to you. Maybe you're doing something right and you're trading really well, and then this helps you actually or other traders see something that's working, and they can kind of hop on trades in that same similar fashion. But yes, personally, I have a journal right next to me at all times during the trading day. Write down my trades. I, have my watch lists, obviously on the computer as well, but I also write them down a lot of the times just to kind of put things in my head. Then I'll put little notes by them, why I like this, what can go right, what can go wrong here. And it kind of just helps you flesh that out. So yeah, every single day, I think every trader should be journaling market thoughts, end of day, kind of what happened, what went right, what went wrong, and what you think can happen in the near future. So I think there is a huge parallel between the journalistic side and the trading side that I think people usually don't give enough recognition to. And I kind of learned that, I guess, from my first mentor in the industry. He's a prolific writer, and I kind of even was able to work with him a little bit on saying, yeah, these things sound good, but then once we kind of look at all the data, does this align right? And we made many adjustments that way. So, that's where I kind of fall on writing, and I think everybody should do it.
Whew, preaching to the choir here. I love that. And earlier in your answer, you had mentioned how you are essentially bookmarking things, and that brought me to social media, which you have, a very, I think, perfect balance of irreverent, but you're also hitting right in on the key points, which is exactly what Twitter is. I mean, look at you have the pinned tweet, which I'm going to read out loud here. I'd rather fail by being true to myself than to perpetually live a lie and succeed just to fit into the societal mold. That essentially is social media and Twitter in a nutshell. So, with that pinned tweet in mind, how do you think an investor should utilize Twitter and social media? Because it can be a treasure trove at times, or it's just a cesspool that you're clicking through.
Yeah, no, and that quote just came to me. So, it was something that I just kind of felt. And social media was definitely part of the target of that. So is just, society as a whole, right? We're sometimes pigeonholed into these roles, and it's more about, be yourself, right? Just be true to who you are, because in the long run, life is short, and if you're not true to yourself, it's something that you may regret later on in life. And to become successful, you don't have to sit with inside that mold itself. I've come from backgrounds with heavy regulatory and things like that. So I think it was something that just kind of spoke to me, and between that and my upbringing as well. My upbringing was kind of made me come up with that quote, I guess, from many different aspects. But with respect to that pin tweet, like I said, for how an investor or a trader should utilize Twitter, I think the biggest thing for me was I hopped on just like anybody else, and you're just bombarded, right, with this
Mm-hmm.
information overload. And how I kind of, viewed it at first was, this is great. It's so much information. Oh my God, I'm going to be the best trader, the best investor in the world. When I was still in college, looking at social media feeds. And then I realized that, 90% of it, you really don't need. So for me, the biggest rule of thumb with Twitter and social media is really curate your feed. Make lists that are probably the most important thing I've ever done. I silo them into specific groups, traders that I know really trade, right? Macro, investment analysis, financial media is another silo, crypto is another silo, sports and politics for fun is another silo. As you can probably assume, politics is my least important one. So on my TweetDeck feed, that one's all the way to the right. Often don't even see that. Probably haven't seen it in a month or two myself right now. So then what I do is I take TweetDeck and just run them from most important to least important from the left to right side. And then that way, what I'm looking for, that information pops out to me from the people that I have determined, have pertinent information. Whether that's from a trading perspective, maybe another trader got on a really good trade, or maybe somebody's, entering a lot of, calls into a position, and not necessarily to bet against them, but to kind of watch that position to say, I don't know if this trade could go sideways, or I want to be with them. So that's one way people could use it. The macro side is you're able to pull out a lot of great people that have macro views. Obviously, there's a lot of people out there that have like the doomsday
Mm-hmm.
kind of macro perspective, and I've seen people fall into that trap, and I try to, definitely veer away from that side of it. I'm naturally somewhat of an optimist, so I've definitely curated that feed to really people that, definitely understand both sides of the tape, understand both sides of the market, but they're not just peddling the marketing fear. Because fear gets clicks. It's one of the sayings is VIX gets clicks. So just like an insurance salesman, fear is what drives you to buy insurance. So I try to remove those as well. And then, some of the most followed accounts I found, and it's, I don't know what it is. They have kind of they're very good at marketing themselves. Sometimes high ego, things like that. People want to be like them. They're the riskiest probably traders out there sometimes, and they can do really well. But it's something that I've always tried to avoid and tried to tell other people to avoid as well, because they could be entering positions and maybe they're not dumping the whole position on you when they tweet and generate volume, but they're probably going to take some of off if that position's going to run up 5% when they do a tweet. So I always tell people to be very cautious about that. If it's a position you really want to get into, let that volume kind of subside, just like a news catalyst would be the same thing, and then take it from there. But for me, it's curate your feed all the way. No better way to put it when you're following social media.
The perfect example is this morning with the CPI. First thing I do, 8 a.m., I'm looking through our tweets, hitting a couple likes, hitting a couple quote tweets, and then obviously the CPI drops, and it is just a avalanche of negativity and the doom and gloom and everything. And you have to almost train yourself just to say, I'm going to log off, or I'm going to look at something else. Uh, Go type in sports, go type in politics, just to get a distraction. And then the other thing that I've been doing is if you going on Twitter for a specific idea, where if I decide I want to write about oil, or if I decide I want to write about Bitcoin, I plug that into the search, and you, like you said, when you trust your curation, which I do New Year's Eve, go through all the accounts and unfollow the ones that don't matter. If you trust your curation, the search and the algorithm will bring up most likely the information that you want. And I feel like that's a balance that needs to be struck, especially for a retail trader.
Oh, exactly. And it's a great way to find, like I said, we're even talking about MMO. It's a great way to find information. Maybe you're missing something. Maybe somebody else is onto something that is extremely important to your thesis. Or maybe you can prove your investing thesis wrong. So yes, exactly. I think that is important to be able to search through that. I have a few searches I think open right now. Usually, before I enter a position, I do search the position just to see what other people are doing. And honestly, my hope usually is that nobody's on it. That's usually the best type of trade that you can find is when nobody's really on that for you. But yes, no, curation is the one way to do it. Or is the only way to really do it, to be honest. And like you said, you can find great information out there.
So we've got about 10 minutes left here. Just wanted to finish with some whip around topics. Having seen your Twitter feed pretty frequently, you're out there with Bitcoin, some hockey. I mean, anything you want to just kind of hit on, for these last wrapping up moments.
Yeah, sure. We can talk about all of that if you want. Obviously, I come from northern Minnesota originally, so I grew up a few hours away from the Canadian border. So hockey's been in my life since I was just a tiny little kid. I was a goalie, so they always say goalies are a little bit strange, a little bit different. I guess that would be why my old kind of Twitter handle even was offbeat, operator, just because I hung out with the kids in sports. I hung out with the kids that kind of like to party a little bit in high school. I was kind of a little bit of everybody, and I was kind of I guess different than both groups as a whole, right? I was just always exploring and curious, trying new things, and being part of multiple groups. Still am a huge fan of hockey, obviously a Minnesota Wild fan here. Definitely got up to a Blue Jackets game once, but got to stay true to my roots. And I think we have a really good team. In terms of Bitcoin, yeah, I do dabble in crypto myself. Obviously, I'm a trader by heart. I'm willing to trade kind of any type of market. Because of my technical background, I feel that I can do it a lot of the times. If I need to learn more macro or fundamentals behind the trade, I will. But the technicals at least let me into the space. Bitcoin's going through a really tough period. It's below that 200-week moving average. I think I had a tweet out there about that, and one of the big crypto accounts retweeted it, and I was curious, to what people thought. When it broke below the 200-week, would it hold, and rebound above that 200-week, or would it be actually the first time we ever broke down through that 200-week? And the surprising consensus was it was actually going to be lower. I really didn't see that coming from the crypto community. I thought most of the time it was going to be higher. So what are we right now? About minus 70% in the drawdown, and
Carnage.
80%. Yeah, it's absolute carnage. But 80% drawdowns aren't unordinary in this market. When I got introduced to it in first time in 2011 from some college kids, was my biggest regret not buying any. They were like, hey, you got to be buying this, and I was like, I'm not throwing my money at this. But then in 2016. Some really well-known investors, kind of got me into crypto, and obviously we went through a really huge bull run, but then we saw another 80% pullback. So where is crypto going to go? We're at the 2017 peak currently, but this thing could easily fall to 2019, 2022 range, which would put us around 10,000 to 12,000 support zone area. I think right now the biggest problem with crypto in the crypto community is it really has a confidence problem with centralized exchanges failing, like Celsius and Voyager, and I believe the other one was CoinFlex. So, it kind of brought on this classic example of a bank run that's happening in the space right now, and I myself included. I had a lot of my extra cash that sits on the sideline in USDC. But when I saw the Luna and the UST blow up happening, I pulled all my USDC out, brought it back to the bank because you want to make sure that's safe. And being on a centralized exchange, a lot of people probably didn't realize you don't have your keys; those aren't your crypto. That's the company's crypto. Technically, you're getting interest on it because they're loaning it out. And when one of those companies blows up, your money goes through bankruptcy hearings, and you're only going to get back a portion of that money at best. So, I think what we're seeing in the carnage, you have, a lot of these altcoins will probably go to zero. Few will thrive and possibly become the next Google, but I think some of the next big altcoins and projects likely haven't even been created yet. And it usually takes these types of environments for that to happen, for them to start building again. So we'll see how it plays out. But that's kind of my stance on it right now. I'm literally in zero crypto. And I usually always kind of held something in a position, but it's just right now the risk is just outweighing the rewards.
Very interesting. I think that's a unique perspective, though, coming from a CMT, to have that stance. And then to circle back to the hockey for a second, I'm not sure if you have watched it or not, but it's on Hulu. It's a spinoff from another Canadian show called. The show is called Shoresy, and I would highly recommend you give it a whirl. Just if you want something dumb, simple to watch, you're going to enjoy it as a hockey player.
I've watched Letterkenny. I'm working on, I believe, season 7 of Letterkenny. Mm-hmm. So that the spin-off show you're talking about with Shoresy there and the hockey players. Yeah, no, it's an absolutely both shows are hilarious. I haven't really seen Shoresy that much. I just saw some of the previews, but the character, Shoresy and Letterkenny is absolutely funny, and it's really kind of true. I mean, it's not exactly how we all speak up there, but I mean, kind of. I can definitely kind of float my A's and things like that. We're kind of close to Canada. We're very similar up in northern Minnesota. Those guys are huge hockey fans. Mm-hmm. They're Calgary Flames fans. So. Love that show. I'm looking forward to moving on to Shoresy myself.
Yeah, so that'll be our part 2. We can do an episode. We can do an entire season review of that. We got Matthew Timpane, Schaeffer, our senior market strategist here at Schaeffer's. We got about 2 minutes left. If you just want to give any last closing thoughts that you have, anything you want to plug, anything you're working on.
Yeah, we're doing something new over at Schaeffer's. We instituted a new program. It's a vertical options trader program where we're buying vertical spreads that are slightly out of the money and then selling, another call option above that or a put option below the strike that we're buying. And the program is set up for being able to kind of take aggressive trades, especially in volatile markets. So there's a couple of beautiful things about this. You're able to take that aggressive trade, and then if you do experience an adverse reaction to it, since you sold that call or sold that put, and if it goes in the opposite direction, what happens is you don't get as much of a pullback in your option price. It kind of saves that a little bit. It allows you the time for it to work out. So it's a new service that we're doing. Our founder is running the service to begin with. And he's had a great year trading. So it's definitely something that I would encourage, any subscribers that are looking to do, some more aggressive type of trading strategies to take that on as well. Or if you're new to options trading, it's a nice way to get in with a low dollar price point as well. Usually the trades don't cost that much since you are buying and then selling another contract against it. It reduces the overall premium that you're going to be paying out to be able to take those trades. It does cap the upside, but that's part of the reason why we're doing it is because it reduces some of the risk in the trade as well.
I'll have the link for that in this episode's bio, so we can for the sign up. That's great stuff, Matt. Thank you again for coming on. This will be the first of many. Let's be honest. We have so much more to talk about. Thanks again, and we'll talk soon.
Yeah, look forward to being back on, Patrick.